Good evening, everyone. Welcome to our Kansas University Alumni Association Homebuyer Workshop. My name is Jason. Great to be with you all this evening. Thanks so much for taking time out of your schedules on a Wednesday evening to learn a little bit more about homeownership. So we're excited to take you on this journey in tonight's class. This is an hour-long session. We'll make this very interactive. We encourage you to ask us questions during the session tonight. So you can use your chat feature in Zoom or Q&A. We'll monitor both windows. So just feel free to drop any questions in one of those windows and we'll take a look at it. But we really want to provide you some different resources and tools as you kind of think about homeownership and what that could look like for you as a future financial goal. We get a chance to teach this class 4 times a year. So it's offered once a quarter through the Alumni Association. You probably heard about us through various different outlets that we have within the Alumni Association. And this is just designed to really help support you guys. And so really excited to kind of take you in this session this evening. Again, my name is Jason. So I work for an organization called American Pacific Mortgage, or APM. We're the 9th largest lender in the country. Our team specifically does a lot of educational classes like this to just kind of really just pour a lot of great education into our local communities. Because let's face it, this is probably one of the biggest financial decisions that you're going to decide to make here soon. And so, taking time out of your Wednesday nights to learn about what this looks like, I think it's a great investment of time, but I also don't think you can be too informed when it comes to homeownership. In this day of technology being at our fingertips with AI and just basic searches that we can do, that's all great. But I think when you can experience a class like this, you can get a lot of questions answered and really kind of help uncover some of the questions that many first-time buyers have all across the country, whether you're buying in Overland Park, or you're out in Dallas, Fort Worth, or you're in Florida or California. It's very similar, the questions we get. Now, the prices of homes look different, but the questions are very, very similar. Like, how much can I afford? What's the process look like? And you're going to learn all about that stuff in tonight's session. Well, here's our talking points for this evening. We're going to talk talking a little bit about the housing market, what's happening with interest rates. Depending on where you're at in the country, housing prices obviously look a lot different. And what's going on in the dynamic of that housing market is different all across the country. We're also going to talk a little bit about, does buying make sense for me? So if we're thinking about stepping up and getting into homeownership, how do we compare that to where we're at financially with renting versus buying a house? We also want to talk about credit. Credit will impact your cost of borrowing. So it's really important for us to try to impart some ways that you can improve your credit score so you can help maximize that score when it is time to taking those next steps and completing an application. And we'll look at some loan programs. We'll do kind of just a quick overview of some different program outlets that are there for you. We also want to talk about savings for homeownership, because it's probably one of the missing links for most first-time buyers, is not having enough resources to put a down payment down. So we'll talk more about that tonight, as well as the buying process, different first-time buyer programs that are available to you. And if you're interested in building what I would call as a home buying plan, we're going to talk about how we get connected after tonight's class. So I spend most of the day when we're not presenting to our clients in different workshop settings, is we work with clients all across the country in designing their home buying plans. So when they are ready to take those next steps, they can feel basically confident that they can get to the finish line and purchase that home of their dreams. All right, so that's our plan for tonight. We're going to first of all start talking about, does buying make sense for me? And you've heard me mention a few times, it's going to be a big financial decision. And so when we think about homeownership, oftentimes clients will look at what they're paying in rent and say, okay, well, I'm gonna have to pay that in mortgage because that's where my budget's at. But I would challenge us to think a little bit differently in that. And here's what I mean by that. When you buy a home, you have the opportunity to create more of a fixed payment, so you're not worried about your rent going up every year. Even though today's market rates are still higher than the historical averages, there still will be an opportunity for clients to refinance at some point in time. And refinancing means that you're bringing down your interest rate because the market conditions have changed. You bought your house at 6.5, now rates are 5.5. And so you want to take advantage of trying to save some money on a monthly basis. There's also growth in wealth that can be created through homeownership. I can't tell you how many times I've heard from clients how homeownership has changed their family's outlook in their finances and allow them to have a building block into the next home. So there's a huge opportunity with that. It's really transformational in what homeownership can do. There's also some tax benefits that come along with owning a home. You can look at potential tax deductibility of mortgage interest that you pay every year on your mortgage. You can also look at potential energy efficient deductions that come along with improving maybe solar to your home, or you're putting on dual pane windows that are more energy efficient. All of those things can really help improve kind of really the overall budget and the cost analysis that we look at when it comes to home ownership. To frame this up a little bit more, I want to walk our class through a rent versus buying calculator. And what that is, it's a comparison of what I'm doing today versus what could it look like tomorrow if I decide to invest in home ownership. And to help us out in this kind of analysis, I thought what we do is look at just a what if example. And so this is one of our calculators that's up on our website. There's also some other calculators that are available to you. Some of your basic payment calculators, refinance analysis calculators, affordability. So encourage you to kind of check those out when you have some free time. Let's assume that we're considering buying a house for $302,000. All right. Now you're going to learn in our product segment that the minimum down payment to buy at 302 is 3% of your purchase price. Now, that means I'm going to finance in my first mortgage 97%. We'll plug in today's interest rates, which we've already kind of pre-filled out here. We have the term of my loan at a 30-year fixed product. So let's say I'm going to buy my home in October. I also have mortgage insurance costs because when I put less than 20% down, I'm going to have mortgage insurance to purchase my home. We have homeowners insurance. We have some property taxes that we want to kind of put into the equation. Property taxes do change by the community that I'm going to purchase in. So it could look different in Kansas City versus Overland Park, or maybe I'm in Dallas Fort Worth area and I'm thinking about buying in Austin. Well, those tax rates might look a little bit different because each community has a different tax rate level. And so that we want to bake that into our calculations. We also want to consider, if we're buying maybe a community that has an HOA to it, we want to consider that into the monthly expenses. And then this is where we got to really figure out where we're at in terms of income, right? So what tax bracket am I at? If I'm looking at home ownership, how much are my expenses going to be to upkeep that home or do type of improvements, or just, in general, just to kind of keep the livability up in my home? So we have maintenance costs. We have eventually a projection of what I'm going to sell my house for and how much is it going to cost me? What my appreciation rate looks like in my home. How much is my home going to go up in value every year? So that's all kind of in our home ownership column, right? In our rent column, we want to look at a situation where I'm paying about $1,500 a month in rent. We have renter's insurance cost, and then we're going to make the assumption that our rental rate that we're paying is going to go up 3% every year. So that's our comparison, right? So we're looking at a $302,000 purchase price home versus a $1,500 rent payment. So what our analysis tells us is that we're going to break even at the 3-year mark. Okay, so what that means is our investments of down payment, closing costs, they're going to start turning profitable after 3 years. And that is a really, really quick turnaround time, because usually we want to break even in 4 years or less. So once I get beyond 3 years, now in home ownership, we should be seeing profitability. Again, that's including equity appreciation, that's including tax benefits. And so, having that quick turnaround in breaking even on your funds is really exciting, but let's look at it from a longer runway. Let's say we're at 10 years. After 10 years, that $302,000 home is now providing me the financial gain of $74,000 versus maybe 10 years, I'm paying now $1,600, $1,800 a month in rent, and I've been paying somebody else's mortgage, right? And so that is really kind of the secret sauce, if you will, in home ownership, that allows us to really prepare ourselves financially and propel ourselves in as a building block into maybe the next purchase, or just making sure that we have good, strong affordability for ourselves in the space of just, housing costs. And then, you can see your equity position here after 10 years. So those are the things I would challenge our class to think about when we're considering home ownership. It's truly not comparing $1,500 in rent versus a $1,500 mortgage payment. It can look, and it will be, so much more for you as you consider home ownership. Well, your entry point to home ownership also depends on what's happening in the housing market, right? What are the prices of homes that are where are they at in the communities that I want to buy in. It may be 250 here in this market here, maybe 350 over here, but ultimately that price point is going to drive what your expenses look like on a monthly basis. Now, as we look at the Kansas market, it's a pretty competitive market, honestly. I mean, if I look at how long homes are staying on the market, we have a 26 median days on market, which is obviously, or not obviously, but it's lower than most markets across the country. So that's very interesting. And a lot of the appeal with the Kansas housing market is the prices of homes. And the price of home, a median price is 304 right now. We had one of your fellow alum just purchase their home a couple weeks ago in the Overland Park area, right around that price point too as well. Had a great experience. In fact, you'll probably see a testimonial from them here pretty soon. But this was a situation where they were in a very competitive market when they made that offer, and the offer was accepted. But what we are finding in some of the markets all across the country is we also have sellers willing to make concessions. So even though we're still seeing the prices go up a little bit in, say, the Kansas market, there is some negotiating happening with sellers conceding credits towards what we call as closing costs. So that's certainly helping buyers in this housing market. Well, what are we thinking for 2026? Well, we're rounding the finish line in 2026, believe it or not. So we're in Q3, getting ready to kick it into Q4 here. So, we're about 70% of the way there. Our forecast originally called for interest rates to go a lot lower. That's obviously changed a lot. We still expect 2026 is going to still be called like more of a reset year for us. But the conflict in the Middle East created a lot of volatility in the markets. We were expecting interest rates to go down a lot further, and they just haven't reacted that way. So it's a very volatile market right now. We didn't expect price growth to be, kind of going off the charts at all, really more of a modest price growth. So we're not seeing any like big jumps. We're actually seeing some decreases in the market, a few dips here. Obviously, the Kansas market not experiencing that, but there's other markets that are a little overheated, starting to see some corrections. Some states have pretty high inventory levels. Florida, Georgia, Colorado, Texas, all considered buyers markets. And so you're seeing just a lot of price cuts. You're seeing a lot of concessions by sellers in those particular states. Inventory has been improving steadily this year, which is giving buyers a little bit more flexibility and leverage. And so as inventory levels change and they go up higher, then buyers do get more of the upper hand. But, I would still say we're still kind of a bit challenged in inventory in most markets across the country. In 2026, and I know we're, 4 months essentially from 2026 being done, I still think there is opportunities to enter this market, even with the 4 months left, because those that are financially fit and feel like they can enter homeownership, I think there's some great opportunities out there. Depends on what market you're looking at, but as I mentioned earlier, interest rates for clients, this is going to be kind of the entry point today is where interest rates are at, but people will have opportunities to refinance their homes over time to help decrease that outgoing expense. This is a look at interest rates over the last 12 months, and this is the wild ride that we have been on, and this is the elevated levels that we're currently at right now. We were pretty encouraged to see where the market was going right about here. Then we saw obviously the conflict arose in the Middle East, and that's kind of changed the markets. We started having to measure what oil prices were doing, and that has since settled down a little bit. But now our attention turns to what's happening in the labor markets, and then what is happening with inflation. And so we have this kind of like really jagged edge of where interest rates are going, usually on a daily basis. But hopefully we'll get a good trend line that's pushing this 30-year fix lower. This green bar here, the green line represents the 15-year fixed product. It is something that first-time buyers can take a look at. 15-year will usually trend lower than the 30-year fixed by about 0.5%, give or take. But this is going to continue to be a kind of pretty choppy market for the foreseeable future, which I would say in the next probably 12 to 18 months is probably what we're seeing. Interest rates are not the same for all buyers, and interest rates change by the minute. So when the financial trading day happens, or opens, I should say, at 9 o'clock Eastern time and then closes at 5 o'clock Eastern time, interest rates will change as we see economic reports come in, something gets said on the news wires, whatever moves the markets, interest rates will follow suit with that. Now, as a buyer, when I'm selecting a mortgage, there's different elements that go into that rate. Things like the credit score and eligibility for a specific product, and maybe I'm choosing a specific loan program or how much I'm going to finance, what my down payment might look like. And there's options as buyers to be able to pay what we call as discount points, where you're essentially putting additional funds out of pocket in order to bring down that interest rate. Usually 1% of your loan amount will reduce that rate about 1/4%. And the term of my loan, so just like I mentioned in the 30-year versus the 15-year comparison, the shorter the term I do, that will also give me a slightly lower interest rate. Like I said, usually about 0.5% difference between a 30-year fixed and a 15-year fixed mortgage. As I meet with clients and we decide kind of what the game plan looks like for you with homeownership and what the right design is for you. We're going to figure out, how we set up your financing to give you the most success in homeownership and, of course, the best affordability. Now, you may be already looking online, taking a look at rates and see, hey, wow, this company's offering this rate. This is what's happening. And as I just mentioned, rates change by the minute during the financial trading day. But I think if you do online searches for lenders or interest rates, there is a pretty big discrepancy in what you see out there in the market. And one way of kind of evaluating that discrepancy is a calculation called APR, or annual percentage rate. And APR is different than the rate that you're paying on your mortgage, because APR essentially means it's a percentage of the fees that you're paying in order to achieve your financing as a percentage in the first 12 months of your loan. And there can be a pretty big difference between an interest rate offering and an APR. So we really want to be mindful of that, because when we do a quick comparison of lenders, and we kind of just did a little snapshot here for you, if you were to look at a scenario like this, you have lender A that's offering a 6.5% rate, and you're like, oh, 6.5%, that I saw another lender that offered 6%. And you're looking at the numbers and you're saying, well, I want the 6% rate because that's going to lower my payment. And at face value, you think, okay, that's the great option for me. However, when you dig a little bit deeper and you look at the comparison, that lender B offering that 6% rate has a much higher APR. And what it's doing is driving up the cost of that mortgage. So even though that rate is lower, you can see the fee structure is just about $7,000 higher in fees than what lender A is offering, even though lender A is at a 6.5%. So that lender B is probably including what we call discount points to bring down that interest rate. So they're achieving that lower interest rate, which catches everybody's eyes. But we have to look a little bit deeper into the fee structure, because ultimately that's going to drive our total out-of-pocket expense. One of the things we do a little bit different with our clients is we always quote with no fees, or no points, I should say. There are fees involved with financing, which are also discounted for you as a KU alum. But when we quote interest rates, we always quote with no points. Now, it's your option as a consumer if you do want to buy points, but not something I would generally recommend, because when you make those investments, it takes about 3 to 4 years to break even on those investments. And quite frankly, we're probably going to refinance in 2 or 3 years. So I wouldn't really want to pour a lot of money into bringing down my interest rate if I'm not going to keep that loan for a long amount of time. Now, as we consider products and different solutions that can help us in this journey, we want to first take a look at credit, because credit can drive the cost of financing. So we're going to spend some time talking a little bit about credit, some areas of opportunity for you. Every loan program has a minimum credit score that's attached to it. And the lowest credit score that has a product offering is 580, which would be for the FHA loan. And we look at the credit score of all 3 bureaus. And there's 3 bureaus that we're all pretty familiar with, I'd assume, which would be Equifax, Experian, and TransUnion. And then we take the middle credit score of all 3 bureaus. So if your highest score is, let's say, 760, and your middle score is 740, and your lowest score is 720, we're going to take 740 as the credit score we use to evaluate your product options. Now, that's for an individual applicant, but let's say we're going to have our partner join us, but our partner's middle score is 710. That's their middle score. Well, we look at the lowest middle score between both borrowers. So in that case, our partner score would be the one that gets used for qualifying purposes. So we would use the 710 credit score. So really, we want to make sure that we're strategic in how we build financing to make sure we try to lessen the cost, because lower the credit score is the higher cost that we could see in financing. Now, when we're looking at identifying areas of opportunity, I'm going to take you through different models of credit scoring, but when you've had challenges in your credit score, especially in the most recent 12 to 24 months, that's going to have the biggest impact to your credit score. There's the most of the low-hanging fruit opportunities for most buyers will be around adjusting their credit utilization, how much they have on their credit card debt. So we're going to take you through kind of what that looks like in just a bit. But as we look at the impact of maybe negative items on your credit report, again, so in the most recent 12 to 24 months, this is how long they'll stay with you on your credit report. So this is a matrix to show you how long the image will show up on your credit report. Now, again, 12 to 24 months impacting the credit score. This is how long they'll stay with you on your credit report. So let me give you an example. Let's say we had a late payment on our student loan back in October of 2025. So we're still less than 12 months. It's probably dragging down our credit score a little bit, but as we get further away from that event, then we're going to start to see that credit score lift. And that'll just have some organic improvement. Now, if I can get that late payment removed by disputing that with the creditor, that'll obviously help improve a lot quicker. But generally, that 12 to 24 month space is where it's going to really impact the score. There are 3 different models to credit scoring. There's the auto financing model. There's credit card, which, by the way, the credit card model is what shows up in most of your monitoring services that you get, whether that's Credit Karma or maybe American Express just sent you your credit update, whatever the case may be. But that's where that usually shows up. And then there's the mortgage model. So you will see variance between those different models. So if Credit Karma says you're at 760, maybe the mortgage model says you're at 755 or 765. But that's just something to be mindful of as you start to take and go through the application process. Here's what that model looks like for the mortgage model. So 15% is going to be how long have I had credit? The more mature my credit file is, probably the higher my credit score is going to be. And then how much new credit am I trying to get access to? So am I opening up new accounts? Am I having creditors accessing my credit file by doing hard inquiries? And we really want to limit hard inquiries because those will have an impact in our score, especially if I have a bunch of inquiries done in the most recent 6 to 12 months. Now, our process is a little bit different, and we get this question all the time from our clients is, hey, Jason, are you going to start our application with a hard inquiry? And the answer is absolutely no. So we start with a soft credit check. And the reason why we choose to do that is because many of our buyers, their time of buying is probably 12 to 18 months out, especially after coming to a class like this. So we want to inform you on your buying options, but not impact your credit score. So when you decide to take the next steps in homeownership, we only start with that soft credit check. Next section is probably the biggest area of opportunity. That's about how much do I owe in revolving debt. That could be credit cards or lines of credit. So we're looking at the outstanding balances versus the credit limits. So let's say I have $10,000 in aggregate limits on my credit cards, and I'm currently running a $7,000 balances on those total credit cards. I'm now at 70% utilization. That's probably taken a hit to my credit score. So our action item first for a buyer in that situation would be, let's try to whittle those credit cards down to where they're below 50% utilization, so below a $5,000 balance. And then once we kind of get to those levels and we've kind of paused our spending, then we want to work to getting below 30% utilization. And then the optimal level is 10% or less. So that's the goal. Now, if you look at one of your credit cards, take a look at your billing statement date because that closes out the 30 days of previous activity. So one of my tips for our class is that try to pay down your credit cards before the billing statement date closes, because if you do that, you catch the credit card issuer before they send out the data to the agencies, therefore getting a lower utilization ideally, and then lifting your credit score. And then the last section is pretty self-explanatory. That's payment history. How have I paid my debt? If I've had any late payments, they're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe the debt, the bigger impact I'm going to have to my score. All right. We're going to talk a little about student loans because that kind of dovetails off of the credit discussion, because student loans are one of those things that I get a lot of questions around in class or just working one-on-one with clients. And student loans, for the most part, are, we just have to navigate those waters because, we have some clients that are currently in forbearance or they're in deferment. And in that case, when they are in those statuses, we have to count a minimum payment for qualifying. And that could generally be 1% of the balances, or if you're doing like a federal housing insured loan, it'd be 0.5%. Now, if you're currently on a savings plan, IBR plan, then that's totally fine. We can use that payment right away. The challenge is when we get into forbearance and deferment situations. But those are things that we'll coach you through during your consultative process with us. And the reason why we have to evaluate student loans is because every loan program has guidelines that are attached to it that tells us what we need to be looking for as a lender. Now, we're going to give you a high-level look at 5 products, but there's plethora of different products out there. And our goal is to obviously match you to the best product based upon your needs and tools that you need to have with you in your journey. The first one is a conventional home loan. That's a Fannie Mae and Freddie Mac loan. You might have heard that terminology, especially during the housing crisis. The conventional loan has a minimum down payment of 3% up into a loan amount of $832,750. That's called the conforming loan limit. And then if you go beyond that loan limit, it's called a high balance loan. And in other markets, let's say like in Virginia or California, Illinois, New York, you can go to higher loan limits, but we do have to elevate the minimum down payment, which jumps from 3% to 5% if we exceed that $832,750 number. And then the next product is an FHA loan. That's a government insured loan. It does have a standard down payment of 3.5%, a little bit more flexibility with minimum credit score requirements, like I mentioned earlier, but the maximum loan amount will change by the county that I'm going to buy in. So it is a government insured loan, as is the USDA product. So those are both government insured products. USDA is a little bit different though, because it's designed for you to purchase in more rural areas, and there's income limit and location requirements attached to the USDA. There's also residency requirements with both of those products. So there were some changes made several months ago that required you at least to be a permanent resident to get access to these two product types. And then the jumbo loan is really for clients that are going to purchase in higher levels in the market, because it's going to require those that do use that product to have higher down payments, maybe higher credit scores, a little bit more in resources. Not really our first-time buyer entry point to homeownership. Is usually for our second and third-time buyers. And then there's the VA home loan. That's for our veterans that have eligibility for the product. That gives you the ability to have 100% financing with a minimum score of 620. There really is no maximum loan amount for the veterans to have participation in the VA home loan product. And it's just a little bit more flexible in terms of how we qualify our clients. And there's also a physician's home loan that we offer, which gives some more relief to actively practicing physicians or veterinarians, dentists, that are maybe have a little bit more debt burden from student loans, that we can get a little bit more relief than maybe what the calculations might look like for, say, a conventional loan. So if you're interested in a physician's loan, let's definitely have that conversation as well too. I do want to explain a little bit about private mortgage insurance. And I also want to talk a little bit about mortgage insurance premium, which is a little bit different because that's on the government side of lending. Because we get a lot of questions around PMI. What is it? Why am I paying for it? How do I get rid of it? That kind of stuff. But PMI essentially, whether it's PMI or MIP, it's insurance that protects the lender against default by the buyer. So if I had an economic hardship, I couldn't afford my payments, then the lender would be protected against that default. Now, on conventional PMI, there's different factors that go into what we pay for the premium. It's based upon credit score, down payment, and then really how much I finance. And debt to income ratio plays a little bit of a role in it too. But one of the benefits with conventional mortgage insurance is that once I reach 2 years in my loan and have 20 to 22% equity, I can apply to have the mortgage insurance essentially canceled. So that's one of the big benefits there. And the higher I can push my credit score, the more I can put in down payment, the better my mortgage insurance costs will be. We gave you an example using our $300,000 loan amount down here. I will say if you're doing some searches on some of the big housing sites, we'll say, be mindful that those calculators aren't really calibrated to some of the elements I shared with you this evening. In fact, I had somebody mention that to me just yesterday. I was quoting them a $110 mortgage insurance premium. Zillow was showing them at a $300 mortgage insurance premium. So just be careful with that when you're doing some of your searches. It's great as a outlet to be able to find different properties on market, but probably not the best for calculators. You can use our calculator on our website, which we'll include in our slide deck that goes out to you tomorrow. The FHA side, a little bit different. Mortgage insurance premium. There are two forms of mortgage insurance on FHA. There's monthly mortgage insurance, which is 0.55% of my loan amount, and then we take that by 12 months to give you a dollar figure on a monthly basis. And then there's upfront mortgage insurance, which is 1.75% that gets added on to your total amount finance. Now, different with FHA is that you can't cancel the mortgage insurance like you can with conventional. So it only can be canceled or basically removed is if you're going to try to refinance from the FHA product into a conventional home loan. Here's the calculation for FHA mortgage insurance. There's the upfront, that's the monthly. So there's going to be some pretty distinct differences between the two product lines, but they do serve different purposes. FHA has a lot more flexibility for our clients that want to put lower down payments and maybe have lower credit scores. It will be kind of a fresh start option for clients that will allow them to get access to home ownership as they, improve their asset position, raise their credit scores, maybe lower their expenses. Then we're going to look to refinance into more of the conventional, more of the long-term product option. All right, we're going to talk a little bit about qualifying income, and that's one of the things that we evaluate as we do consultations with our clients to figure out like what's the verifiable income that we can take a look at, and then we compare that against their expenses. Here's some of the documents that we will generally ask for to validate that income and some of the assets used to purchase your home. And then I want to kind of talk a little bit about different employment scenarios because I get a lot of questions around that. Especially for some of our new graduates that are just newly in the workforce. Like, when can I buy a house? Do I have to wait for 10 years? What does that need to look like? Well, the way it works in lending is that you have to verify a 2-year work and or educational history. So I don't have to be on my job for 2 years. I could have just started in January and I only have 8 months on the job, but I could still potentially qualify for a mortgage as long as I can show educational history for at least 2-year history, along with 2 years of work or work history. Maybe it's a combination of both, right? But I just ultimately have to show 2 years of work and or educational history. So that's the basic kind of rule of thumb. Now, if I'm self-employed, a little bit different because I have to show that I've been active with my business for at least 2 years in tax filing. So that looks a little bit different from that perspective. If I have a compensation structure for an employer that I have a base salary plus, let's say, bonuses or commissions, I do have to show that I've been with that employer for 2 years in order to count those variable sources. If I'm an hourly employee and I get a lot of overtime because we have seasonal work that I really have to do a lot of lifting on, then in that case, I have to show that I've been with that employer and actively receiving overtime with some continuance for the last 2 years. Okay, so that's kind of the biggies that come up in some of our conversations. We also have in some instances where we have clients, especially in the tech space, that maybe are working for startups and have some restricted shares or work for some of the bigger tech, more established firms, and maybe they work for Google and they get a heavy load of compensation in restricted shares. We can use that as transition into income, but we have to show they've been with that employer for 3 years to be able to make a complete analysis of the valuation of those stock holdings. If I have dual employment, so sometimes I work for 2 different employers in different markets. If I want to count both sources of income, then I have to show that I've been working with both employers simultaneously for the last 2 years. All right. And the last thing I just want to share, it's more so around clients are looking to buy in the income property space, like multifamily situations. If you want to use projected rents to purchase your home, if you're buying a multifamily property and not using a first-time buyer program, projected rents can potentially be used to help you qualify for your mortgage. Okay, so what that would mean is, let's say I'm going to go buy a house and the house is a duplex, right? It's a 2-unit place. I'm going to live in one unit. I'm going to rent out the other one. Potentially, we could use that second unit that's going to be rented as projected income to help me qualify for my mortgage. All right. Let's talk a little bit about expenses versus income. And we're going to do a quick look at what we call debt to income ratio. And that is a look at my today's expenses coupled with what my projected expenses look like with my house. Now, we're not talking about utility expenses and things like that, but we're talking about the principal and interest of my mortgage, property taxes, homeowners insurance, and if I decide to put less than 20% down, mortgage insurance. So that all gets baked into our housing expense calculation, coupled with other expenses that I have today, like my credit cards, my student loan, my car payments, all that kind of stuff, right? So we generally want to see that those expenses don't exceed more than 45 to 50% of my pre-tax income. So if I'm making, $8,500 a month pre-tax, I can't have those expenses exceed, 30, 42, 50 of my income. Now, here's an example of that calculation here. So you have someone here that's spending $2,500 a month in projected housing expense. They have $500 in existing debts, and they're making $8,500 a month. So our debt to income ratio analysis tells us that 35.3% of their income is going out to those expenses. Again, highest we can go is 45 to 50%. The sweet spot, I would say, is probably something below 36%, is generally pretty good, 33 to 36%. I will say every client across the country has a different tolerance level. You may be in Santa Clara County and just trying to make it, and your debt to income ratio is at 47%, but it works. And you have a partner that's contributing that's not on the loan. So that might be okay. Or, you might be in another market that, hey, I don't want to be over 25% debt to income ratio. That doesn't make me feel good. And so we'll have those conversations with you to see what the right design is. Affordability is really important in homeownership, and we understand today things are just more expensive, but we still want to get to a goal of affordability when we design plans for homeownership with our clients. Our last stop in our discussion tonight is to talk about down payment. It's probably the one ingredient that we really got to get figured out because it's probably a challenge for most buyers. Just kind of not being able to close the gap in terms of what they have available in resources. And we'll talk about first-time buyer programs in just a second, but let me share with you some of the acceptable documentation that we can use to validate what assets you can have as part of your home purchase. Of course, checking and savings accounts can be used. You just can't use cash when you buy a house. So we have to season all assets that are used in a home purchase for 60 days. So, of course, you get your payroll from your employer, all that stuff gets direct deposit. That's totally fine. But we're talking about, putting $5,000 in cash into your checking account from an undisclosed source. That can't be used in a home purchase. We can certainly use investment accounts, 401ks, 403bs, brokerage accounts. So you can use those. We just want to get you to first have a conversation with your financial and tax advisor because you don't want to create any tax events or losses in the market, whatever the case may be. And then gift funds can also be used in a home purchase. That's where a family member is helping you to kind of get some additional resources to pour into your home buying plan, so you can kind of close the gap of what you need to be able to pay for a down payment, as well as closing costs and prepaid items to purchase your home. So when we think about home ownership, you guys learned a little bit more tonight about, hey, this is the minimum down payment, but there's also other expenses like prepaid items and closing costs, which we'll talk about in just a bit. But we're gonna have to save up for some of that stuff if we're not ready right now. And so I wanted to share with you a really simple savings plan that can really help support that kind of reaching goal of home ownership. So let's say today I'm at that $1,500 rent payment that we've talked about a few times in various scenarios, but I think I can get to a $3,000 mortgage payment based upon what my new salary is and kind of how I'm trending with bonuses. So I think I can get to 3,000, but I have this gap, right, in terms of savings. So what I would encourage our clients to do is let's start making a savings payment or a rent payment, so to speak, at $3,000 each month. So what I mean by that is $1,500 on the first of the month goes to your landlord. The other $1,500 that we think we can pour into a mortgage payment goes right into our savings account. And we do that meticulously month in and month out. By the end of 6 months, we have $9,000 that's grown in our savings account. By the end of 12 months, now we have $18,000. That doesn't even take into consideration if you're putting into like a high yield account with, say, an American Express high yield account paying 3% interest. So there's ways that you can get there. It might take some time, but I think a savings plan like that can be super beneficial for you. Now, there's also assistance programs that can help you in this journey. In the state of Kansas, there's the the Housing Resources Corp. They can provide you up to 15 to 20% in assistance for down payment and or closing costs. It is essentially a zero interest loan and can be forgiven after 10 years. There are some income stipulations to that. We have a kind of a matrix that we can take you through, but that's another great resource. Internally within APM, there's our Pathway DPA program, which provides anywhere between 3.5% to 5% of your sales price in assistance funds. It is only compatible with an FHA loan. And then we also have the 1% program. And what it is, the 1% program offered within APM is essentially a program where if you contribute 1% of your own funds in that minimum down payment of 3%, APM will grant you another 2% up to $4,500 to cover the minimum down payment for you to purchase your home. And that's a great, great tool to be able to get that access to homeownership. And it really works in states like Kansas, where our price points are in that $300,000 range. So that's something we can take a look at as well for you to be able to get access to that grant. In fact, that's what one of our alum did here a couple of weeks ago in leveraging that product. You heard me mention a little bit about closing costs when we think about savings for homeownership. So it's not just that 3% down payment. There's other expenses involved with purchasing a home. So closing costs are third-party fees. They can be lender fees, title company, escrow company, attorney fees, local county fees. Those all go into different line items that are part of closing costs, and they vary based upon different parts of the country where you're going to purchase. Closing costs not only vary by location, but they also vary by your loan type and ultimately kind of what you negotiate with the seller. I always tell clients on the safe side to budget yourself about 2 to 3% of the purchase price for closing costs. But there's also what we call prepaid items when you purchase a home. Prepaid items would include like your prorated taxes for your home, homeowners insurance. We call it prepaid interest. So that all goes into our calculation as well. At the time we do a pre-approval, we're going to provide you some general estimates in our presentation about what we think the closing costs are going to look like. But it will depend on the type of property you buy and when you buy, and then how you negotiate with the seller. Some markets are more favorable for buyers where you can really have some leverage. Others not so much, and you might be paying a little bit more on closing costs. Once you're under contract with the seller, so that means you have an agreement with a seller, then we will be getting fees from either a title office or an attorney's office. And then we're going to itemize all those fees for you so you understand exactly what you're paying for. Now, part of our KU alum discount, we also discount our services as your preferred lender to help kind of just make financing just that less costly for you. Now, what are some ways you can maybe lower those closing costs? Well, negotiating with the seller to cover more initially is great. But you can also ask for seller credits, where you can get, let's say, $5,000 credit towards your closing costs and help really offset or maybe reduce down a lot of what your expenses are for your home. There's also programs that, like first-time buyer programs, that can help provide some assistance that can help give you a credit towards some of those closing costs. So there's different ways that we can customize the options for you and figure out what product matches best for you. Before we go into our workflow of homeownership, I did want to point out that if you're not in Kansas, that's okay. There are first-time buyer agencies all across the country. They're usually called HFAs or housing finance agencies. We have a list of different resources available on our website. But if you're looking in a different part of the country, wherever that might be, let me know, because I can provide you some different resources and we can talk through different scenarios and assistant options that might be able to be something you can plug into. All right, well, we're rounding the finish line in class, and I want to talk to you a little bit about the buying process. Like, where do you go from here? So hopefully we've kind of sparked a little bit of interest in home ownership, and you're thinking, hey, yeah, this might be something I might be interested in doing, or maybe you're already there and you just want to kind of get all your facts together. But we would obviously love to be able to help guide you in your path towards home ownership as a preferred lender in the community. And that next step from our session today starts with a consultation. It's a free service that we provide to you, and that's where you and I meet for a one-on-one session for about 30 minutes, just designing your home buying and just figuring out where I want to buy, what my budget needs to be, how much I can put out of pocket. Do I need to, implement assistance options? Really important things that you should be informed on before you take those next steps in home ownership. But once we conclude that session, then we issue to you a pre-approval. And the thing I always like to point out in our classes is I'm not expecting you to run out this weekend and buy a house. It's probably something that's going to take several months, maybe even a couple of years. But I think the pre-approval gives you a little bit of a baseline of where you're at financially. So when you're ready to take those next steps in homeownership, you can feel confident that you've been evaluated of what your options look like. So that's kind of where we go with step one. So you've done a consultation, you've gotten your pre-approval, then it's to step two. And step two is probably the longest stage in the process, because you may be looking for that perfect house, perfect community, certain school district, whatever that might be. But that's where you would go from there after the pre-approval consultation. I would encourage you to talk to a local realtor that can be a resource for you. They should be an expert negotiator. They should know all of the checklist items that you have in a home. But again, that could take a little bit longer to find that right home. Now, at some point, if you're still plugged into home ownership, you're going to find the right home. And when you do, that realtor will help make an offer to the seller. And if that offer gets accepted, then we're going to now move to step three, and that's called entering escrow in most parts of the country. So the seller has accepted your offer. That day I get advised that you've been accepted. I'm going to call you and say, hey, congratulations. You got your offer accepted. Let's talk a little bit about what you should be expecting now, which will include setting up a follow-up consultation time with us to be able to kind of go through all your numbers and timelines and see what you've negotiated in your contract, help you really understand what's in your contract. And then you'll get a home buyer checklist of kind of your to-do list for yourself. Okay, so that's what really happens the day we get word of going into escrow. There's also other action items for you, like making your deposit on your house, which is called an earnest money deposit. That deposit is usually 1% to 2% of your purchase price, and it counts towards your total out-of-pocket expense. This will also kind of jumpstart other activities for us, like getting your appraisal ordered on your house. Your realtor will start organizing inspections on your place. And so that'll kind of really start getting the process going. Now, generally from a time of acceptance to the time you get your keys and you're starting to move in, it takes about 30 days in most parts of the country. Sometimes it's 45 days, but I'd say 30 days on average. Now, we can also look at more competitive markets that will be like 14 days or 21 days. But general rule of thumb, it's about 30 days. This is what an earnest money deposit looks like. It is 1% to 2% in most parts of the country. It does count towards your total out-of-pocket expense. And it's protected by what we call contingencies in your contract. And they're phrased differently in different parts of the country. And different parts of the country have different timelines. But this is a general rule of thumb. So you have your appraisal contingency to make sure the house is worth what you're buying it for. And that's really important, especially in today's climate. We want to get inspections done to make sure there's no issues that you're taking on. And we want to make sure your loan gets approved. And there should be no issues with loan approval, but we want to make sure that we have everything figured out that way as well. So that all happens within the first week or so of the contract. Now, that contingency is going to take us about to step 5 in the process. Now, in the meantime, we're going to start doing some different administrative things like verifying employment and assets. Of course, we'll be meeting for your follow-up video session. And you heard me mention earlier about interest rates, right? So once we get to step 3 and we're under contract, now we're going to talk strategically about interest rates, because now we can start thinking about locking in the interest rate, because we don't want to, miss opportunities in the market, because there's windows of opportunity, especially in a volatile market like this. We are experts in kind of really navigating the markets. And so, as we see an opportunity to lock in the interest rate, we definitely want to have that conversation with you. Step 4 is, like I said, the administrative stuff that we're doing in behind the scenes as your lender. As we move through every milestone, you're going to be getting disclosures sent to you that highlights all of your financing, maybe some of the assistance programs that you're electing. And then step 5 is our loan approval. So that means an underwriter has approved our loan. It also takes us pretty much about 3/4 of the way through the process. And at that point, we're going to be delivering a final closing disclosure to you that's going to give you a 3-day cooling off period, just to make sure everything that you've seen in previous disclosures all aligns to the final disclosure. And then that takes us into our final milestone, which is called closing the loan. And in Kansas, for example, that all happens on the same day. And what that means is you're going to be signing documents, deliver your funds, and as your lender, we're also going to deliver our funds all on the same day. And everything gets recorded that same day with the county recorder's office. They're going to record a transfer of ownership, which is kind of a grant deed is what they would call it, and then a deed for the mortgage. And so all that stuff gets assembled and finalized all on that day of closing. So if your closing date is, on August 26th, that's the date you officially become the owner of the home. Now, different parts of the country, there's sometimes about a 24-hour delay, but this is what we call a table funding state in Kansas. So the day you close, then you become the homeowner. We get to say, congratulations, you did it. You're now a new homeowner. Time to go out and get your keys and start the moving truck up, get your sold sign in front of your house, whatever celebration you need. But, our relationship doesn't stop there with our clients. Part of our aftercare program, we're going to stay connected with you to help, really support you on your financial journey after homeownership. Whether that's just keeping you up to speed on what's happening with interest rates, or that's better understanding what your home equity looks like in your home, or just checking in with you on an annual basis to see how you're doing financially. We want to be there as just really more of a resource for you. Now, as we're wrapping up class, I just want to kind of give you a sense of like how you can move forward in the process. If you want to get connected with us to learn a little bit about more about your journey towards homeownership, I'd love to be able to partner with you in exploring those options for you. Really simple process to get started. Starts with an online application. Remember, we only do a soft credit check, so you don't have to worry about your score being impacted. You'll then upload documents to your application, and then you use our really simple scheduling system to schedule your 30-minute virtual consultation time. And we'll meet up just to kind of figure out like, what's this all look like for you. Now, maybe you have some questions after tonight's class, whether that's, hey, I just don't really understand that terminology, or can you go back through that slide? Connect with us for an introductory call, especially if you don't get your question answered tonight. I'd love to be able to just kind of get a chance to meet with you and just kind of understand more about where you're at in your thoughts on home ownership. This is kind of what our consultation service looks like. It's a free service, and there's no pressure to buy. We work a lot differently than various lenders in the marketplace because we want to be here as a resource for you. Our expectation is to provide you tools and resources and guidance. And then when you feel like, hey, I'm in a good spot financially, then you can take those next steps to going out and exploring home ownership. Technology is something we lean into quite often, whether it's some of our AI technology or our mobile tools. And so you can start the process all mobilely if you want. We can also follow the progress of our loan all through our digital services. But I always like to share in our classes, like it does not replace the human element of this really big financial task. This is something that AI can't replace. Just having the human touch of being able to call us and say, hey, here's how I'm feeling about this. Can you give us some guidance? We want to make sure we're here every step of the way for you. You heard me spotlight our KU discount. So that is all included for our clients that we work with across our community support. Of course, you always can check back these classes for live classes. This class will be up on the recorded version on our YouTube channel tomorrow. So get in there, take a look at it, give it a like. If you want to share that with friends and family, love to be able to pass along that content all across different communities. We also have other community partnerships. So if you do have some interest or have friends or family or colleagues that attended some other schools, we do offer different courses. We still have a pretty big slate of classes available for the rest of 2026. Here's all my contact information. So if you want to get connected with me after class, please reach out to me. I'd love to be able to meet you and see how I can help guide you to home ownership. And of course, or if you feel more comfortable, you can just schedule a free consultation with me. And this is all kind of our social. So check out some of our reviews online. I love what our community says about us. It brings me so much joy to see how we've impacted the lives of those we serve in our communities. It's pretty cool stuff. And try to put a lot of great tools on our socials too. So give us a follow on Instagram. I think we got a lot of good stuff out there that we can help you as you're kind of exploring what home ownership could look like for you. All right. Well, that takes us to the end of class. I didn't see any questions pop in, but I do want to, we have a few minutes left in our session. So any questions from our audience that I can help answer for you? Any questions, you can drop those in the chat. You can use the Q&A, whatever you feel more comfortable with. Okay. Okay, you're welcome. Glad it was helpful for you. Thank you so much for attending. Yeah, and we don't have to have questions, so it's totally all good. I mean, I hope I take that away as like we were super thorough. So, but if there's something that you don't feel comfortable asking in this forum, just reach out to me. I'm more than happy to answer any questions for you. We're here to help support you. And I hope you guys have a great rest of the week. I was in Lawrence. Let's see, I was in Lawrence last year. Hopefully, I'm gonna make the trip out there again for another basketball game. Hopefully, it's gonna be a successful season for the Jayhawks. So if you guys are out supporting, hopefully we can get some wins this year. But I wish you guys all the best for a great rest of 2026. And I hope I get a chance to connect with you all soon. So have a good night, everyone.